Welcome to Chapter 11. Chapter 11 simply means we're almost to Chapter 12, and that's all the further we go. It's really exciting. This chapter focuses completely on liabilities. You can see current liabilities, contingent liabilities, and payroll becomes one huge liability, and we'll talk about that later in the week. Very similar to when we analyzed AR, so when people owed us money, this is when we owe people money. People or businesses, of course. I see us getting through these two today and tomorrow, if I can go fast. I'd like to get through some end of chapter stuff as well. I think it'll be pretty easy for you to do if I have to assign a little bit of homework. All of us will be gone Wednesday because seniors will be at senior mentorship. Juniors will be taking the ACT. I'll be in the Twin Cities. You'll come back for Thursday, Friday for a recorded version of what we're doing. We get into some pretty tricky stuff here in section 11.3. If I decide I want to slow down and teach the FUTA and SUTA, those are acronyms for something that if you read the whole chapter you saw. If I decide I'd rather teach that to you live Monday, I think we'll still be okay for a chapter test next Friday. So we'll see how that all shakes out. I would prefer that you're watching the videos as a class and just hit pause if I'm going too fast. So let's get into the first section. It's actually pretty easy, talking about current liabilities. Current right away tells me that it's a year or less. Exactly what number 2 says. A company will pay the debt within 1 year or the operating cycle, whichever is longer. Okay, and what you need to know about current liabilities, so people, we are going to pay off RAPs, in some cases NPs or notes payable. We're going to pay that from our current assets. In fact, we'll do a ratio here to determine the health of our company at the end of this lecture. So basically, you're going to be using your current assets like cash to pay off the current liabilities that are owed on. Other examples, maybe you'd have an AR that you're going to turn around and get cash for within a year. That'd still be considered a current asset to pay a current liability. As we break down what we're going to cover, yes, it's shown here, but I'd rather show you this list. So this is a list basically of the current liabilities that I'm going to talk about. You'll see little snippets in your student notes. I think most of them are pretty obvious, but let's talk about them. Notes payable, you might say, notes payable, aren't those longer? Well, if they're paid within a year, they're considered a current liability. Sales tax payable, I can't wait to talk about this because this is going to happen to me this week. Unearned revenue. So in other words, it's been prepaid. We just have to do the work. And I'll give some examples and some journal transactions there. Current maturities of long-term debt. So in other words, if long-term debt is becoming due during the current year, it basically, even though it's considered long-term, it's current because it's going to get paid right now. And then we'll analyze it with yet another ratio that you'll learn about. So that previews the section just a little bit. Good old notes payable. We've learned about them. We've talked about them. It's basically a longer loan. From a definition standpoint, it's a written promissory note where you take principal times rate times time. Okay, we know all about time, that it's either expressed by 360, by 12, or divisible by 1. Days, months, or year. This formula, principal times rate times time, allows the lender to make money. Are we the lender on a notes payable? We're the borrower this time. Okay, We are borrowing the money, if that's how it's going to read. So then we're going to pay to borrow this money. Issued for varying periods. We already talked about days, months, and year. And you have to stop at the fiscal year end and say, what interest has accrued for that year? It's happened, it's just that it hasn't been paid. Let's do our first transaction together. It actually will have 3 different transactions, which we will outline, so write small. First National Bank agrees to lend $100,000 on September 1st. If Cole Williams Company signs a $100,000 12% 4-month note maturing on January 1. Here's what's super annoying. We see 2014. It's actually going to mature on 2015. So it's spanning more than one fiscal period, hence the reason for B. The first one is we're going to get the money. The second one, we have to stop and say what happened at the end of the fiscal period in interest that's accrued. And finally, what happens when we pay the money back. So we are going to take a peek at each of these. One thing I will say, this is 2014. Even though it's been one day, there's 2015. I like this transaction because they make you do the 3 different components of it. When we get the money, we stop and what's accrued, and then the next time when we pay. So here we go. Let's take a look at each of them. Same scenario here. Here's our players. $100,000, 12% 4-month note. Prepare the entry on September 1st. So in other words, when the money comes in. Cash went up. If someone gives us $100,000, that's money in the bank. Okay? There's some big strings attached here. What's the credit on this? If we get the money and we owe someone, in this case it's a notes payable because of these factors. Okay, and we signed on something. Had it not been that way, it would have just been an accounts payable. But because there's that factor, that 12%, 4 months, we're signing documentation, it becomes a notes payable. Even though it's only a 4-monther, it's still got those strings attached. Got the money. I don't know what we're doing with it. I don't know if we're buying a delivery truck. I don't know if we're doing a renovation. Whatever the case is, we have now $100,000 that we're going to owe on. Plus what? Plus interest. Remember, notes payable are interest-bearing instruments. However, we had it all September, we had it all October, November, and December. It's going to mature on January 1, but that's not in 2014. These are the 2014 entries. So we have to stop and show what interest has accrued. You will see interest expense go up. I'll talk about why it's 4,000. And you'll see interest payable go up. Our $100,000 12-month note has spanned 4 months right now. The reason we're dividing it by 12 is because it says a 4-month note. So we've used it all of September, October, November, December. How much interest has piled up? So now, not only do we owe on our note $100,000, we also owe on interest payable as well, $4,000. Turn the calendar to 2015. What are we going to do with the maturity date? Maturity date is 1 day later. It's maturing. Is cash going to go up or down if we're paying at our maturity? You will see cash go down. Absolutely. What else is going to be wiped out at maturity? Notes payable and what happened at December 31st? interest payable. So you see notes payable go down because normally a payable has a credit when we debit it. You know, had I done this, notes payable initially, when we got it, it went there. When we're paying it, we're wiping it out. We also have one for interest payable. That's also going down. One day prior, we had to say what happened in 2014, what interest was owed. Now it's getting paid. Cash out is going to be the 100,000 plus the 4,000 because it cost us $4,000 to borrow this $100,000 over the course of 4 short months. I really like that problem because he shows you when you get the money, stop and what accrued, and then when you pay it off. So that should feel easy. Did that feel easy to you? Good way to start a Monday. Let's go on to the next kind. So we talked about notes payable. If I had to go back, here's our running list. I'm going to go through all of these. Notes payable. Now I'm going to move on to this one. Talk about it, show you an entry. Talk about it, show you an entry. So do you see what we're doing here? Hopefully. The next one, sales tax payable. Oh my goodness. Sales taxes are expressed at a stated percentage of the sales price. And you approach this one of 2 ways. They're either rung up separately at the time of checkout or included in the total receipts, which that's typically what happens. You go buy something for 10 bucks. Do you pay 10 bucks and then pay them separately for sales tax? No, it's all embedded right in the price. Or excuse me, it's all embedded right on the receipt. And you see it itemized, like here was your bill, and then here plus sales tax to equal whatever. That's, would you agree that's how most retailers do it? The retailer serves as a collecting agent that turns around, and here is the payable part. In Minnesota, the overall sales tax rate is 6.875%. Okay? So as I bring all of my Junk by Jenny stuff to the Metro and sell, I have to pay the state of Minnesota 6.875% sales tax. Now, the payable piece is I collect that from the customers, but do I get to keep it? I'm just a collection agent. I'm collecting it to turn around and pay it to the tax authority when it's due. And I don't pay it right away. I pay it in February of all months. Okay, yes. Okay, that was a decision I made 2 years ago. 2 years ago, I was just kind of a hobbyist, kind of having the fun sales, selling on Sell at Morris. And the business teacher in me said, it's time to tell the government what I'm doing. And so it's that fine line of, okay, I guess now I'm official. I went and got an official business number. I registered with the state of Minnesota. I registered with the IRS or the Internal Revenue Service at the federal level. And then now I'm legally obligated to, every time I ring up a sale, I collect that money from that customer. I don't get to keep it. And it becomes a huge, it's very much accounting intensive because I have to track every sale. Some counties where I'm going, I actually am going to charge of that 6.875, not plus, I'm actually going to be charging 7.3% sales tax where I'm going. Certain counties have higher sales tax, more industry, more tourist. Up in Douglas County, you pay more sales tax because where you're selling, the location. Yep, because it's more tourist based. There's a lot of reasons for the increase, but it's not based on where you live or are from. It's based on where you're selling. Okay, good questions. Now, again, I don't get to keep that money. I legally owe it The retailer, so Junk by Jenny in this case, is going to remit those collections to the State Department of Revenue. Do you think that's something you should mess with? I'm not going to pay you. No. Now, one question that I get a lot, you know, what I do with, I don't want to deal with cents. When I have a long line of junkers in front of me, I don't want to be dealing with quarters, nickels, and dimes. So basically, I embed that 7.3% in my prices. So a $30 chair, I'm going to round up. So I might charge just a hair more, but then I'm just dealing with a $30 chair instead of a $20 chair. I'm gonna build my sales tax right in it, but it's very much a figure of, I better know. My husband always tells me, you better have enough money to pay that government all that sales tax payable. And that's what it becomes. Take a peek. On March 25th, the cash register reading for Cooley shows $10,000 and sales taxes of $600. The sales tax rate happened to be 6%. So what's the journal entry? Cash in the cash register was $10,600. Sales revenue was only 10 grand because we have sales tax payable, another type of liability. Here is the hard part, and here's absolutely where retailers get in trouble. They see this, like they're literally counting 10,600. It is not all theirs. They earn the 10,000 in revenue, but in this particular, I don't even want to say state because you just saw me explain the Minnesota sales tax, and where I'm going in Carver County, it's higher. This money is not mine, even though it's physically sitting in front of me. It's a payable because you owe it to your state tax authority. Next kind of liability, unearned revenue. Revenue is received before the company's done the work. Money is there, money is in, and the work has not happened yet. It's hence the unearned. Money is sitting there. I haven't earned the right to that money yet. I always tell stories of a bridal store that went under. Can you imagine those brides that had prepaid for their wedding dresses? And it was time, or the wedding parties, or prom dresses, and literally they shut the doors. Unearned revenue. They kept the dress and they kept your money. Ouch. Messy, messy, messy. Talk about a bridezilla, okay? They gave 3 examples. Is this in your notes, these little 3 examples? They're not there? Okay. A couple different types. The airline industry operates with unearned revenue. You prepay for your tickets and you don't ride the airplane until your scheduled date, travel date. Yes, and then let's talk about when there's 150 canceled flights. Talk about a mess. Okay, so the unearned, it's called unearned ticket revenue, but when it turns into revenue, it's again turning unearned into earned. When you get on the airplane and fly and use your tickets, they've earned their unearned revenue. What's that one? I can't even read it and I don't want to move that thing. Magazines. You typically buy a year's worth of a magazine subscription, right? And every time you get a magazine in the mail, a little chunk of unearned becomes earned. Hotels. You typically hold your card. I think that's a little bit of a bad example. Instead of hotel, I'm going to call it an apartment. You typically pay for your rent, say in the beginning of the month. What happens if they decide to lock your door and not let you in one night because they're going under? Well, it's there. The unearned becomes, as you live there, it becomes earned. Another example would be season tickets to the Vikings. Okay, typically you buy that on the front end, right? Very expensive, and you better hope that the games are played. Okay, you get tickets to a Beyonce concert. You better hope Beyonce shows up. You hear a lot of times when if the performer gets hurt or they have to cancel the show for whatever reason, you have 30,000 people that have pre-purchased tickets, and then the unearned never becomes earned. Ugh. So from an accounting standpoint, when you work in these industries, it's a big deal. Let's take a look at how it would look in a journal transaction. Superior University sells 10,000 season football tickets at $50 a crack, and they have a 5-game home schedule. They are. The university makes the following entry for the sale of the season tickets. Cash goes up by $500,000. 10,000 tickets at $50 a crack. Have they earned their money though? It's called unearned ticket revenue because the 5 games haven't happened. You better hope the field's not destroyed. You better hope that these people are truly playing their games. Do you see where things get messy? As the school completes each of their 5 home games, as each home game occurs, unearned becomes earned. So as it occurs, as they do their job, in this case, a football game is played. As they do their job, unearned becomes earned. This goes down and revenue goes up. This is considered, in this case, a current liability. Unearned revenue of any sort is a current liability because what do you owe? What's owed? The work, the performing, the home football game, the airfare to the airline trip to wherever you're going. So as that occurs, that revenue, the unearned liability is wiped out. So next time you hear of a concert being canceled, think about it a minute. What a mess this is. Another one, we're still on my list of current liabilities. Okay, I see the word long-term, and that doesn't, to me, mean current or short-term. Current maturities of long-term debt. A portion of the long-term debt that becomes due in the current year. No adjusting entry is needed. You just say, hey, this big, huge long-term debt was due this year. So then it is considered, because it's happening in that year, a current liability. But you don't have to do an entry with it. Okay. What does this all look like on the balance sheet? On the balance sheet. Do you have the balance sheet in your notes? Okay. Guess I was shortchanging your notes a little bit here today. You know, you see all these assets. That was last chapter. We're not going to worry about that. But you take a look at the order, current liabilities, and then they just list them out. You might ask, what order are these in? Sometimes they're in alphabetic order. Sometimes they're in order of liquidity, like how fast they're going to turn into cash. This example isn't, but the book when I was reading the book about it, typically they're in order of magnitude, so the balance. Okay, So again, you sometimes will see that list in alpha order, liquidity order, like how fast we're going to get the cash out of the deal, or pay them off in this case, not get the cash, pay the cash, or sometimes in order of their magnitude or size. Oh, I spelled that wrong, sorry. In other words, the balance. The last bit that I want to talk about in regard to current liabilities is how fast can we pay them off? The analysis is this, and you really need to look at it in two ways. Two ways to look at the analysis side of how quick we're paying this short-term debt off. One way is working capital. Another way is considered the current ratio, and I want to break them down. They both are dealing with current assets, current liabilities. It's just how you're doing the math. If you look at it from a working capital perspective, you take your current assets minus your current liabilities to equal working capital. If you think about aloe, and you just move your equation around, the working capital version of figuring this out is basically what I highlighted there with the arrow. Current assets minus what you owe is what you're worth. Instead of calling it what you're worth, this is your working capital, how much you have to work with. Because if I am sitting here at $38,000 in current assets minus $28,000 that I owe, I really only have about $10,000 in working capital to work with. Okay. Down here, if you look at it from a ratio perspective, you'll notice the operators change. Instead of minus, we're going to divide to get what's called a current ratio. The book talks, and what does that mean? Here's what I'm going to show you. The book talks about the accepted ratio out there in the industry right now is what's called a 2-to-1. For every $2 in assets you have, it's about $1 in liabilities. And so that ratio simply means if 2-to-1 is acceptable, so this business is underperforming a little bit, they have probably too much debt or not enough assets. 2-to-1 simply means for every $2 in assets that you have about $1 in liabilities, giving you about $1 in working capital. And that is the first section of the chapter. I would like to do, ready for this, 5 quick exercises, brief exercises, excuse me. I don't think all of them are in your workbook. You can sure peek. We're going to do brief exercises, not exercises. If they're not in the workbook, you of course can do them in your notebooks. And they're fast and easy. 1, 2, 3, 4, and 5. Looks like we're on page 550 in the book. It's basically asking you to figure out which is a current liability or a long-term liability. The last sentence there, for each obligation, indicate whether it should be classified as a current liability or not. So is it going to be turned or paid off within a year? So there's 3 little scenarios. Jamison Company has the following obligations at December 31st. A, A note payable for 10 grand, or excuse me, $100,000 due in 2 years. Is that current or considered long-term? I see 2 years. It would definitely be considered long-term because of its 2 years in nature. Remember, current liabilities are paid off or liquefied within a year or less. The next one, a 10-year mortgage payable of $300,000 in 10, 300, or 30,000 annual payments. Remember, anytime long-term debt is being paid in the current year, even a portion of it, it is considered a current liability. So although this, what was it, a $300,000 long-term? Yeah. So even though the $300,000 long-term mortgage spans 10 years, 30 grand is considered current because that's what's going to be paid this year. So what gets tricky, you would see notes payable of 30,000 under current liabilities, and you'd see probably the remaining 70,000 as a long-term liability. So whatever's going to be paid that year is considered current. The rest, like they see in that, the remainder should be reported as long-term. C, interest payable of 15 grand on a mortgage. Seems to be an annual thing. Interest payable is a current liability because it will be paid. Remember, interest payable is the stop. Let's update our interest accrued before we move on to the next year. If it gets paid off in the next year, you see that reduced. Last one, D. Accounts payable of 60 grand. Well, accounts payable tell me it's always a current liability. So that's as simple as brief exercise 1.1 is. What can I answer about questions there? All right, let's move on to number 2. Peralta Company borrows 60 grand on July 1. Signing, I already know it's a note, not an accounts payable, it's a notes payable because I signed something. 60,000, 10%, 1 year note payable. Again, I love this. They say record the entry of the note, record the stop, update accrued interest. We got 60 grand, but we also owe 60 grand. So both of those are going up. If I'm going to go buy a $60,000 piece of equipment, I literally get the cash, but now I have this long-term debt, well, short-term debt in this case, attached to it. Bought it on July 1. Stop and say, okay, at the end of this year, it's a 1-year note. We have to stop and say, well, what has piled up in interest? Okay. Interest expense goes up, but now we also owe on that interest payable. Where did we get the 3,000? We took our principal times rate times 6 of 12 months. They simplify the fraction there, but whatever. So from July 1 to December 31, we've had $3,000 on that note pile up. Are we going to have more pile up? Yes, because only 6 months have passed. It is a 12-month note. There again, that is easy, easy peasy. They don't have us journalize what it would look like when we paid it, but that's okay. On to brief exercise 11.3. Coughlin Auto Supplies does not segregate sales and sales tax. So what that simply means is they don't say, okay, please pay me this for this $10 shirt, now pay me separately for the tax. No, they're going to bundle it all together on the receipt. They don't segregate them at the time of sale. The register total for March 16th is $16,380. All sales are subject to 5% sales tax. They're going to they want us to figure out how much cash is in there, and then we have to separate what was revenue and what do we owe to the state government. Is this in your workbook? Fabulous. Does it give you some computing space? Even better. Okay. I want to do this a little bit differently. Hang on a minute. Okay. I want to just run these numbers a little bit different. Cash register total. How much money was actually in the cash register? Okay, 380 or 388? Okay. Stop and ask this question. Do we get to keep all that money? Because how much do we owe to the taxing authority? 5%. Now here's where it gets a little bit weird. We actually are going to divide this by 1.05. I want to talk about why that number is that way. It's 100% plus the sales tax percentage. If you want to go to page 525 in the book, they give you a breakdown of why it's 1.05, not 5%. Sometimes companies do not enter sales taxes separately. To determine the amount of sales in this case, divide the total receipts by 100,000 plus the sales tax. So receipts 100% plus 6% or 1.06 times the sale. That's how you get that number. So then we take the amount that's in our cash register divided by 1.05%, breaks that down to 15,600. Those are the actual sales. That was the sales revenue. Now we can multiply that times 5% to figure out how much we owe to the tax authority or sales tax payable. So we first have to divide it by 1.05 and then we can multiply it times 5%. So on this $16,380, we owe $780 out of it. And I know that's maybe not the approach the book, like the little computation showed. I just like my version better, just because it definitely shows you where the players go. Another way to check your math, you could take the 16,380 to make sure you did this right, minus 15,600 is 780. It's a nice way to quickly check that you did your math right. So then from a journalizing perspective, your cash in your cash register was this. We just have to separate it out to say the 15,600 was the revenue, and we owe the tax authority or sales tax payable $780. And just the more you do that, where you divide by 1.0, whatever the percentage is, and then you take it times, got to break it down. We get to keep the 15.6. We owe the 5% sales tax. Let's keep rocking here. 2 more? 3 more? 2 more. Okay. So on the next one, we're dealing with some unearned revenue. So in other words, people have paid us. It's just that we haven't performed our service obligation, hence the reason it's a liability. Derby University sells 4,000 season basketball tickets at $210 a crack for its 12-game home schedule. Enter the sale of the season tickets, and then enter the revenue recognized by playing its first home game. So cash is going to go up. Unearned ticket revenue is also going to go up by $840,000. This is a liability. What do we owe in this case? What do we owe? Why is this a liability? We haven't played any games. We owe them 12 home games. So where do we get the 840,000? We sold 4,000 tickets at, how much was it a ticket? $210 a piece. They've paid for that money up front. The liability is we owe them 12 home games. Okay, after we play our first season opener, we've played one of our 12 games, have we earned some of our money? Have we earned a little bit of our keep? Not all of it. We haven't earned 840. Rather, we have earned 70,000 of it because we've done one of our games. So we've taken that 840,000 of unearned, divided by 12 because we're going to play 12 home games to equal 70 grand. You see unearned turned into earned. So this is wiped out. That's a good thing. When a liability goes down is a good thing. We're just going to do that entry every time we play a home game. And eventually the 840 will be gone. And as we have home games, ticket revenue will go up. We turn unearned into earned. Remember, from an analysis perspective, this is now exercise 11.5. We can analyze our asset to liability bit one of two ways. We can look at working capital, which is the minus, or we can look at the ratio, which is the dividing. Yahoo, we're talking Yahoo here, holy cow. Yahoo's recent financial statements contain the following data: current assets and total assets, current liabilities and total. Remember, when we're working through working capital or current ratio, all we care about is current. To do working capital, remember that's the minus one, you simply take current assets minus current liabilities to equal the working capital. Basically, what we own minus what we owe typically is what we're worth, but in current liquidity bit, it's, well, how much do we have in working capital? From a ratio perspective, you take those same two numbers, it's just a divide, and Yahoo's doing well. Remember, 2.1 is the industry norm. Like for every $2 in current assets you have, you better have half of that in liabilities. And they're actually at 2.67. You wouldn't want them flipped. You wouldn't want for every $1 in current assets, you have 2.67 in where it's owed. That's when wedding dress shops shut their doors and there's bridezillas. Because that means you are continually in the red. You cannot pay your bills. That, my friends, is the first section of the chapter. You cranked through lots of current liabilities, knowing that there's different categories. We talked about each, and we did journal entries for each. Do you feel good about it so far? Good. The next section talks about what are called contingent liabilities. Like today, we'll go through the lecture. We'll do some end of chapter work right away.